Hi, I'm Niziolek, Co-CIO and Head of Global and International Strategies here at Calamos. Today I'll discuss the genesis of the Evolving World Growth product. This is an emerging market product that we've launched more than 8 years ago. And what's unique about this product is really the genesis. This was a collaboration of our investment team and our sales department to develop an emerging market solution for our clients that would provide all the access of the growth opportunities and the upside potential that we saw in the emerging markets, but within a vehicle that dampened the volatility for our clients and provided more downside protection. You know, we view emerging markets as a great long-term opportunity. There's a significant secular growth themes there, and there's many great innovative companies in the emerging markets. But the emerging market asset class can be and has and continues to be very volatile. And oftentimes clients look at it as more of an opportunistic allocation, moving capital in and out of the emerging markets and often at the wrong time. So we wanted to create a product, a solution for our clients that provided emerging market growth exposure, but in a vehicle that allowed our clients to sleep a little better at night and to stay allocated throughout the market cycle, providing some of that downside volatility dampening while giving as much of the upside participation as we could. So the investment team discussed the tools that we had and the experience that we had to create this type of product, and we were leaning on years of experience and several key levers to produce this product. One key point of differentiation is the use of convertibles. We have an almost 40-year history of using convertibles at Calamos, oftentimes invested in emerging market convertibles over that time period. And as we looked at the convertible asset class, emerging markets was a smaller piece of the overall asset class, less than 10% of global issuance. But we expected that to increase. As the financial markets develop in emerging markets, as growth continues to grow in emerging markets, as companies need to access the capital markets and benefit from the lower rates that can be realized in a convertible vehicle, we felt more and more companies would turn to the convertible market for issuance, and that would provide us more opportunities for our clients. So we give ourselves the flexibility in this product to own 20% of the portfolio in convertibles that have exposure to the emerging markets or are domiciled in the emerging markets. This is a great volatility damper for our portfolio. It really broadens the opportunity set for us. And when we do get these EM risk-off environments or global risk-off environments where great companies are sold off with good companies, these convertible structures, bond floors can oftentimes kick in, help provide some of that downside protection, some of that volatility dampening that we like for our portfolio. But as active managers also gives us the flexibility to reduce those positions and sell down those more defensive structures and roll into some of our higher quality, more attractive emerging market equity or convertible positions at that time. The second lever that we have in this portfolio that is somewhat unique is using our fundamental process of understanding where all the revenues and assets are of all the companies that we invest in. We've leveraged this experience to identify companies that get a significant percentage of their revenues or assets from the emerging markets. This has permitted us to broaden the opportunity set and really identify the companies that round out the portfolio and provide our clients with the best exposure to the emerging market growth story. One example from when we originally launched the product is one of the investment themes, the secular growth opportunities that we were seeing in the emerging markets was the growth of the emerging middle class, and more specifically, the growth of aspirational luxury and the opportunity that we saw with consumers wanting name brands and higher end products within the emerging markets. When we looked within the EM universe of how to access this opportunity, there was very limited opportunities. There was several Chinese retailers, but these were more poorly run companies where we felt there was a lot of excess capacity, and these weren't the best opportunities for our clients. But with this expanded opportunity set, we were able to identify several Switzerland-based developed market companies that actually receive more than 50% of their revenues or assets from the emerging markets. You know, they're participating in the emerging market growth story. The equities trade very much in line with how the emerging markets are doing or not doing at that particular time. And these companies own the brands and actually have the value that the consumer wants. And we felt like these were better emerging market growth opportunities than what the index provided. So by widening this broadened set, by widening this opportunity set, utilizing convertibles where appropriate, utilizing some developed market positions with significant emerging market equity, significant emerging market exposure, as well as owning emerging market equities that fit our investment process of high quality, high growth, and really benefiting from many of the secular themes that we're seeing in emerging markets, we feel like we've provided a better solution for our clients. The realized volatility since inception has been close to 0.7 beta, while we've been able to outperform over shorter, medium, and longer term time periods. Thanks for joining me today, and look to calamos.com for additional insights on the emerging markets.